Hello everyone. Hope I'm audible to everyone and also my screen is visible to everyone. So guys, as I told you, we're going to be solving certain more sample questions for your examinations, which is going to be asked mostly in section C. Correct? So section C, as I've already told you that we are going to deal with mainly our section C consolidation questions. So last time, in the last class, as far as you all remember, we did a sum on consolidated statement of profit or loss, correct? Which was from the past exam papers. This another sum is also a preparation of the consolidated statement of financial position, which is also a paper chosen from the past papers. I mean, a question chosen from the past papers. So let us get started with Dargent Company. Okay. Now, this is a big scenario to be dealt with, to be honest. So please focus throughout the way so that you all can understand it clearly. Okay, guys. Now, let's get started with the question. So, guys, Dargent Company on 1st January, wait, I'll just increase the size so that it is clearly visible to everyone. Yeah. So let us understand our section C question, Dargent Company. On 1st January 2006, Dargent Company has acquired 75% of Latry Company's equity shares by means of a share exchange of 2 shares in Dargent Company for every 3 shares in Latry Company, right? Acquire. On that date, further consideration was also issued to the shareholders of Latry Company in the form of a $100 8% loan note for every 100 shares acquired in Latry Company. None of the purchase consideration nor the outstanding interest on the loan notes at 31st March 2006 has yet been recorded by Dargent Company. At the date of acquisition, the share prices of Dargent Company and of Latry Company are provided as follows. That is nothing but $3.2 for Dargent Company and $1.8 for Latry Company. So I think $1.8, which is for the Latry Company, that is mainly provided for calculating the NCI at fair value, and Dargent Company is mainly provided for calculation of the share exchange, that is a cost of investment, correct? So in this, as we know from the first adjustment, we can identify one thing, that is we will have to make adjustments to your goodwill. Cost of investment calculation is going to be particular number of steps covered, right? Now, this is the statement of financial position which is provided to us, okay, in which we have our equity, non-current liabilities and also the current liabilities, and quite a few adjustments required for preparation of the financial statements, right? So required is what? Prepare the consolidated statement of financial position for the Dargent Company as at 31st March 2006. So this company was acquired when? It was acquired on 1st January 2006, and we have to prepare the financial statements. I mean, we have to prepare the consolidated SOFP for 31st March 2006. That means it is a mid-year acquisition and only 3 months are covered here. That is January, February and March. Right? So firstly, we are going to prepare our working notes, that are 5 working notes for consolidated statement of financial position. So let us head on with working note 1, that is nothing but group structure. Right? So guys, I'll just maximize the size a little bit so that it will be clearly visible to you all. Yes, I think this much is sufficient. Yeah. So working note 1 is nothing but group structure, wherein I'll just mention the initial name, that is D company, right? It is D company, right? Dargent Company has acquired Latry Company. So D company, or you can also say Dargent Company, rather I'll just mention Dargent Company, right? Has acquired Latry Company, and that is on 1st Jan 2006. And they have acquired how much percentage? How much percentage of the company has been acquired? 75%, correct? So 75% of the company has been acquired, right? This is the working note 1 and the relevant information that I require to be mentioned within my working note 1. Now heading on to working note 2, guys, right? So our working note 2 is nothing but net assets of the subsidiary company, that is nothing but Lattery company, right? So we have Lattery company's net assets at acquisition, right? Then we have it at the reporting date. I'll just write it as RD. Okay, just a second. I'll just increase the size to quite a limit so that we can complete the sum at once without getting back to it, right? So, guys, here we have mentioned at the reporting date and at acquisition, and we will get the difference as the post acquisition profits or losses, whatever we are considering. Okay, firstly, now we have the net assets of Lattery company, wherein probably we're going to have the share capital, correct? So the share capital at acquisition is how much? You can see it from the financial statements, or they must have, where is the share capital? Yeah. So see this one, guys. Equity section, equity shares of $1 each, 20,000 shares are there for Lattery company, right? So the share capital at acquisition is 20,000. Obviously at the reporting date it will be same because there is no change, right? If there is any sort of share premium, then we'll consider share premium. But I don't think there was any sort of share premium stated here. No, there is just retained earnings, correct? So we have our retained earnings of the subsidiary company. What is the retained earnings of the subsidiary company? The retained earnings of the subsidiary company at 1st April 2005, here it is 19,000, okay? And here it is 8,000, correct? So retained earnings at 1st April 2005 was 19,000, and for the year ended 31st March 2006, it is 8,000, correct? That means technically maybe for the profit for the year, it is 8,000, right? Now, the retained earnings accumulated till 1st April of the subsidiary is 19,000, correct? The retained earnings accumulated till this date are 19,000, and that is till 1st April 2005, correct? Now for the year 31st March 2006, the profit may be is nothing but 8,000, correct? Okay, here I had to maximize. Yeah. Now it will be visible. Yes. So this is the retained earnings at 1st April 2005, correct? And these are the retained earnings, or maybe say the profit for the full year, right? Profit from 1st April to 31st March, right? 2006, correct? Now we have acquired the company not on 1st April 2005, right? We have acquired the company when? On 1st Jan 2006. That means when we acquired the company, after that only 3 months have passed. So this 8,000 profit, this is available for the full year. That is from 1st April 2005 to 31st March 2006, right? So what is going to be our profits? Firstly, at the reporting date, the total profits that are available is nothing but the total retained earnings at the reporting date are available is nothing but 19,000 plus 8,000 till the year end, correct? So that is 27,000. 27,000 is the total retained earnings that are available at the reporting date, right? Because we are preparing the financial statements for which date? 31st March 2006. Until 31st March 2006, the total retained earnings are going to be 19,000 already available plus 8,000 profit for the year. That brings us 27,000, right? So at the reporting date, the retained earnings of subsidiary are 27,000. But we have acquired the subsidiary only 3 months ago, correct? We have acquired the subsidiary only 3 months ago. So from this 8,000, 9 months relate to the pre-acquisition and 3 months relate to the post-acquisition, correct? That means for us, the profit that is going to be there is nothing but for January, February and March. Before that, whatever is the profit earned by the company, that is a pre-acquisition retained earnings of the subsidiary company. So that is going to be deducted in order to identify the pre-acquisition profits, right? So 3 months are going to be deducted from here into 3 divided by 12, right? So this is the profit for 3 months, that is 2,000, correct? 2,000 is the profit for 3 months. So if I take 27,000, which is the total, and subtract it from the profit of 3 months, that is 2,000, I will get the retained earnings at acquisition, correct? So my retained earnings at acquisition are going to be nothing but 25,000, correct? Because what we have done here is for the full year, right? For the full year till 31st March 2006, our profits available were 27,000, but this included also the 8,000 which was for 12 months, right? So out of this, 3 months will belong as a post acquisition profit, right? So that is from 1st Jan. So for identifying the pre-acquisition profits, we have to identify that what are the retained earnings at 1st Jan, right? So that means for the month of Jan, February and March, if we eliminate the profit, then in such a case, we will get the profit for the previous 9 months, right? So I've eliminated the profit for 3 months, that is January, February and March. And thus I got the profit at 1st Jan, that is nothing but 25,000. So this is the pre-acquisition retained earnings available to me. And thus my post-acquisition will be nothing but 27,000 minus 25,000, which is going to give me 2,000. Okay. So this is the retained earnings. This was the necessary information that is to be mentioned, right? Now, there would be certain other adjustments which will be required to make. So I'm just leaving some space after preparation of the working note too, and we'll start with the first information that is available to us. That is for the calculation of goodwill, whatever is the purchase, right? So guys, you can see here, on 1st January, Dargent Company acquired 75% of Latry Company's equity shares. By what means? By means of a share exchange of every 2 shares in Dargent Company for 3 shares in Latry Company acquired, right? Firstly, the total shares of Latry Company are nothing but 20,000, right? And we have acquired 75% of it, correct? So, cost of investment, we have to first consider in the cost of investment the share exchange, the payment in the form of share exchange that we are making. Okay, so that will be nothing but 20,000 is the total share capital of the subsidiary company into we have purchased 75% of it, right? So what is the statement saying? The statement is saying that for there is a share exchange of 2 shares given by Dargent Company for every 3 shares Latry Company, for every 3 shares of Latry Company acquired. So we have first understood that we have acquired 20,000 into 75% shares of Latry Company by doing what? By giving up 2 shares and receiving 3 shares, right? So into 2 divided by 3. And what is the share price of each share that we have given? It is nothing but $3.2, which is already mentioned in the question, right? And that should be always of the parent because the parent is making the payment in the form of shares. So how much payment is going to the subsidiary company's other shareholders is we are supposed to identify, right? So you can see here in the last line that Dargent Company and Latry Company are $3.82 and $1.8, right? So the share price of Dargent Company from this we can identify it as $3.2. So that is what I've taken here, and thus the calculation of share exchange is going to be nothing but 20,000 into 75% into 2 divided by 3 into $3.2. That is going to be nothing 32,000, right? So this is the first information that we have completely dealt with, but there is something also pending here. You can see the third line, the last word, on that date, further consideration was also issued to the shareholders of Latry Company. That means further consideration is paid to the existing shareholders of my subsidiary company, right? For purchasing the subsidiary company, I am paying certain consideration to the existing shareholders of the subsidiary company in the form of $100 8% loan note for every 100 shares acquired in Latry Company. So that means I am paying the existing shareholders of Latry Company by issuing a loan note, right? So by issuing a loan note, I am paying them $100 8% loan note for every 100 shares acquired in Latry Company, right? So here what will happen? Don't get confused. This is not an intra-group loan given. It is not given to the subsidiary company. It is given for the purchase of subsidiary company to the existing shareholders of the subsidiary company. Okay. So This is nothing but our 8% loan note. So it is obviously going to be capitalized to the value of the goodwill. And 8% loan note, guys, is nothing but what is the information stating? Right? The information is stating that uh, on that date, further consideration was also issued to the shareholders of Latry Company, and it is the consideration is actually paid for in the form of $100 8% loan note is given for every 100 shares acquired in Latry Company. Right? So I am acquiring 100 shares of Latry Company, and for that I am giving a loan note to them, to the existing shareholders, which will give them the right in the future date to receive the interest payment and also the capital repayment. Correct? So 8% loan note for every 100 shares acquired in Latry Company. Right? So how many shares have been acquired in Latry Company? Obviously, it will be the same thing, that is nothing but 20,000 into 75% into, we have given up $100 worth of loan stock and divide by 100 shares acquired, right? So we have given up $100 worth of loan stock, divide by 100 shares that we have received, right? So our value is going to be nothing but 20,000 into 75% into $100 divided by 100 shares that we have received. $100 given, 100 shares received. So whatever is given shall be the numerator, like we did in the previous one, because we are given 2 shares, so that was our numerator, right? Then we will have our non-controlling interest, right? Non-controlling interest also, they might have firstly provided an information regarding it in the adjustments. Which is that adjustment for non-controlling interest? I don't think it is here. It should be somewhere. Yes, this one. Second adjustment, guys. So Dargent Company's policy is to value the non-controlling interest at fair value at the date of acquisition. So we have to use the fair value method for calculation of the non-controlling interest. Okay. So what is fair value method? It is nothing but the number of shares that belongs to NCI multiplied by the subsidiary's share price, right? So for that, as I told you, $1.8 is mentioned here. That is the share price of the subsidiary. So we have to firstly calculate the number of shares which is with the NCI, which belongs to the NCI. So 20,000 into 25%, because we have acquired 75% of the company. So 25% belongs to the NCI, right? Into what is the value of each share? It is $1.8, correct? So my NCI valuation will thus be 20,000 into 25% into $1.8, correct? And that is going to be nothing but 9,000. From this, then eventually we are going to subtract the net assets of subsidiary company at acquisition. I'm so sorry, guys. This is going to be subtracted. We have not calculated this as yet, and is the reason why I'm not doing its calculation. Okay. And also, guys, we have actually made a share exchange. So that means technically we would we have to issue shares out in the market, correct? So what are the number of shares that is issued in the market? So firstly, obviously, cost of investment. I'm just passing the journal entry so that you can keep it in mind, right? Because with journal entries, it becomes quite simple, right? So what is the value of the share exchange? 32,000. That is capitalized as a cost of investment, right? For purchasing the subsidiary company. 2, it will be share capital account, and also 2, share premium, right? So what is the value of the share capital and the share premium? It will be nothing but, guys, 20,000 into 75% I've acquired, right? So what is 20,000 into 75%? 15,000. So 15,000 shares I've acquired. I'll just mention it here rather, because probably it won't fit in here. 20,000 into 75% shares acquired into 2 divided by 3 into the share capital will be at its nominal value, that is nothing but $1, right? So the share capital value will thus be 15,000, which is 20,000 into 75% into 2 divided by 3 into $1, right? That will be 10,000. And for the share premium, it will be the amount above that, which is nothing but the same thing, but only it will be the amount above that, that is $2.2, right? So $1 will be my share capital, the other $2.2 out of the total $3.2 will be nothing but my share premium, right? So 20,000 into 75% into 2 divided by 3 into $2.2, correct? That will be 20,000. So this is the basic journal entry that we are supposed to pass here. Okay. After this, we'll calculate here the goodwill, and after that, yeah. After that, we will get the goodwill which is to be stated, right? If in case there is any impairment, impairment will be deducted. Now calculating also the working note 4, that is going to be nothing but non-controlling interest, right? So for a non-controlling interest, guys, we have the non-controlling interest at fair value already calculated. From working note 3, we have that value with us, right? That is nothing but 9,000, correct? Non-controlling interest at fair value. Then from here, we will add certain share of post-acquisition profit share, right? Profit share of NCI. Okay. And thus, after that, if there is anything else to be mentioned as per the adjustments, we will do that. Okay. Just leaving some space for that. Working note 5, the last part, that is nothing but the group retained earnings, which has the parents retained earnings firstly. So what are the parents retained earnings? It must be directly mentioned here. Yeah. So the parents retained earnings at 1st April 2005, that means the opening is 20,000. And for the year ended, it is 16,000. So 20,000 plus 16,000, that is going to be 36,000, correct? 20,000 is for the opening plus 16,000 till the year end, right? So it will be 36,000. This is the parents retained earnings. So this we have it complete, right? Then the post acquisition share, post acquisition profits, group share, right? Whatever share belongs to the group. And then any other adjustments will be dealt with separately. Okay. Now, let us go through the adjustments because I think we have made the necessary basic information that was to be stated, right? Now, let us look at the first adjustment. At the date of acquisition, the fair value of Latry Company's assets were equal to their carrying amounts. However, Latry Company operates a mine which requires to be decommissioned in 5 years' time. Okay, so this is a bit trickier. Okay, no provision has been made for these decommissioning costs by Latry Company, and the present value discounted at 8% of the decommissioning is estimated at $4 million, and it will be paid when after 5 years from the date of acquisition. That is at the end of the mine's life, right? So firstly, the mine that is there, okay, the mine asset or whatever you want to call it, right? You're going to capitalize this. What is this, guys? This is a provision, correct? This is a provision which is to be created for dismantling cost or decommissioning cost. So if you remember IA 60, dismantling or decommissioning costs are capitalized to the value of the asset, right? They are capitalized to the value of the asset and simultaneously a provision is made. But if you see here, it is a payment made after 5 years, right? So we are presently obliged is the reason why we are capitalizing it and creating a provision for it. But the value is not going to be the value of 4 million, which is to be paid after 5 years, right? We have to present value it because it is a future value which is going to be incurred after 5 years, correct? So we have to present value it, and that will be capitalized as the value of an asset and also a provision made. And then in the future date, I mean for the year 1, 2, 3, 4, 5, we are going to charge finance cost and keep on increasing the provision to actually restate the balance. I mean to actually restate the liability balance to its actual amount, that is 4 million. Okay. So we'll just prepare probably a separate working note for this, shall we? Yes, guys. We'll prepare a working note for this here. Maybe I'll do it here. Working note 6, mining provision. Right? So, guys, working note 6, mining provision will be how much? Firstly, for our net assets, okay, this mine value that is 4 million, correct? Where is it? Sorry, not here. It is here, right? Yeah. This mine value, which is 4 million, right? The present value is already mentioned here. Okay, sorry guys. So now, as I told you that we have to present value it, but there is no need to present value it because they've clearly mentioned that the present value, which is already discounted at 8%, is $4 million. That means this $4 million, rather than calculating the present value of it, it is already mentioned. Okay, so this is going to be capitalized as an asset, right? 4 million, because it is the present value of an asset, or you can say the fair value of an asset. Because for an expense, for an asset which is to be incurred, for a dismantling cost which is to be incurred after 5 years, that is capitalized at its fair value, and its fair value is nothing but its present value here. Okay, so 4 million is its present value, or you can say fair value. So this will be adjusted in working note 2, right? Because the subsidiaries assets have increased, right? So you can call it a mine asset, right? Mining asset, or whatever you want to call it, right? At acquisition, the subsidiaries asset value has increased by 4,000, correct? 4,000, right? And this is a fair value adjustment, to be honest. Okay. Yeah, this is a fair value adjustment. Okay. So mine asset is stated. Now since it is an asset, it will be depreciated, and obviously the depreciation charged will be nothing but the useful life of this mining activity, that is nothing but 5 years, because the dismantling is going to be incurred after 5 years. And we have acquired the company 3 months ago, so we will charge depreciation of only 3 months. Thus the depreciation charge, which will calculate the carrying value, is nothing but 4,000 into 3 divided by 12, oops, into 1 divided by 5, which is depreciation, into 3 divided by 12, which is the time apportionment, right? So the depreciation for the fair value is nothing but, I'll just write your fair value depreciation. Okay, so this is your fair value depreciation of mine asset. Okay, now always remember, since you're creating an asset, right? You create an asset, so it increases your asset value. Your mine asset is created. With that, you also create a provision of the same value. Okay, so if it is 4 million here in the asset side, it has increased. 4 million in the provision side also it has increased. That means these two are going to be cancelled out, correct? So these two are going to be cancelled out. So in order to cancel out, I'll just mention the mine provision also, right? So the mine provision again is nothing but 4,000, right? And that will be subtracted, because obviously your provision is going to deduct your net assets, right? And your mine asset is going to add your net assets. So add by 4, which is an asset, and deduct by 4, which is a provision for that same asset, right? Why we are adding this separately and not just cancelling them out or ignoring them? Because here the depreciation of it will be affected, and here the finance cost of it will also be affected. The interest on provision that we pay, correct? So the interest on provision that we pay, that will also affect my retained earnings at the year end, correct? So I have to also charge the interest on provision, right? And I'm stating it here because it is related to the subsidiary. If it was related to the parent, then in such a case, it would have been deducted from the retained earnings in working note 5. Okay, so interest on provision will be nothing but 4,000, right? And this will be multiplied. What is the cost of capital? It is 8%, right? The cost of capital is 8%, or the interest rate mentioned is 8% into 3 divided by 12, right? Do you remember the unwinding? It is, this technique is nothing but unwinding of provision, right? What do you do in unwinding of provision? So the fair value, the initial value of provision is 4,000, right? And eventually whatever amount you're supposed to pay, you have to reach that amount. For that, this is already present valued at a percentage, that is 8%, correct? So I will have to charge finance cost every year, right? Finance cost account debit to provision for your dismantling. I will have to charge this, right? And that will be nothing but 4,000 into 8%, that will be 320 each. Okay, but the total amount is not going to be there here. It is going to be 320 into 3 by 12 because obviously our months that have been covered are only 3 till date. Okay, by the reporting date only 3 months are covered. So it will be nothing but 4,000, right? I'll just click this cell, 4,000 into 8%, 8% is here, into 3 divided by, correct? So that will be 80. So this minus 80 is also stated in my post acquisition. This depreciation of 200 is also stated in my post acquisition, correct? And thus, I think this adjustment is done for. Let us just look at if in case we can close our net assets of subsidiary or not. Okay, so we are done with adjustment 1 completely. Adjustment 2 is also done. Adjustment 3 is relating to inventory. Includes goods from the Dargent company. Okay, so this is not affecting my okay. Who is the seller? The inventory of Latry company includes goods bought from Dargent company. So Dargent company is the seller. So it is not going to be affecting my working note too, even if there is a POP. Right? Because the seller is the parent company. So it will affect my group retained earnings. That is working note 5. Okay, then the next adjustment on 28th March 2006, Dargent Company dispatched goods to Latry Company with a selling price. Okay, here also the parent company is the seller. So here also it is not affecting my working note. At 31st March 2006, Dargent Company's records show a receivable. Okay, this is a adjustment in the current accounts on the statement, on the face of statement of financial position, correct? So this also is not affecting my working note too, right? And these are goods on transit. This is also an effect on the face, right? Lastly, the investment. Okay, this is for the investment in associate adjustment. So this is also not affecting. So I think we are done with our working note 2 here. So we'll just get the totals, right? So our totals is going to be 45,000, correct? Yeah. 45,000 at the date of acquisition. At the reporting date, it is 46,720, and the post acquisition profit is nothing but 1720. Correct? So now our goodwill, we have our net assets of acquisition to be nothing but 45,000, right? And thus we will get our goodwill. We did not see any of the adjustments mentioning the goodwill impairment. So I think this is the final goodwill amount that has been stated, right? So we are done with 3 working notes. Heading on to the next working note, that is working note 4. So we have our post acquisition profits. Correct, guys? We have our post acquisition profits. So post acquisition profits are nothing but 1720 as calculated earlier, right? That is the last value of the last column in the working note 2, right? 1720 into 25% belongs to NCI. Correct? So into 25%, that is going to be nothing but 430. Okay, I don't think there are any other adjustments here, so I'll just close this also. That will be 943, right? Then what is the share of the group? It will be nothing but 1720 into we obtain 75% of the company, right? So that will be 1290, correct? So we have got our post acquisition profits also here. Then I think that is it. Now we have to look at something else. So, okay, I had made this, but this is not required. So I'll just delete this part. Yeah. Now, we have not looked at other adjustments. I am not making those adjustments yet because obviously your working note, your uh, share of profit in associate is also going to be affecting your working note 5, that is retained earnings. Correct, guys? So that we are supposed to also calculate and then add it to the retained earnings is the reason I am not closing it right now. Okay. So as I see, I think there is one adjustment for POP, right? We'll do that adjustment first. Let us look at POP. Where was it? First 2 are done. Yes, this one. On 28th March 2006, Dargent Company dispatched goods to Latry Company with a selling price of $7 lakh. These were not received by Latry Company until after the year end, and so have not been included in the inventory. Okay, these are goods in transit. Okay, these are goods in transit, right? So if there are goods in transit, what do? We assume that the goods which are in transit, that has already been received, right? So if it has already been received, that means it would debit the inventory, right? Inventory account debit. And if it has already been received, the entity which is liable to pay will create a payable for it, right? So payable account will be credited, right? That means we are adding up to the inventory and we are recognizing a payable for it, right? Because we've received the goods, so it will be in my inventory and I will thus have to pay for it, because as I have now received the goods, so I am obliged to pay for it, and that will be nothing but 700,000, or you can just say 700, right? Yeah, so this will be for goods in transit, that we will do directly on the face of statement of financial position, this adjustment. Now let us look for the perp adjustment. I don't know where it is. Okay, so we have another problem in receivable and payable due to the goods in transit. Records show a receivable due from, okay, this is the related to the same one. Okay, this is the same related adjustment. Okay, let us look at for the intra-group transaction. The intra-group reconciliation should be achieved by assuming that lottery company has received the goods before the year. That we already know, right? Okay, yeah, this one, third adjustment. Here is the perk. The inventory of lottery company includes goods bought from Dargent company for 2.1 million. Dargent company applies a consistent markup on cost of 40% when arriving at its selling price, right? So it actually includes a markup of 40% on cost when arriving at its selling price, and the goods are bought at 2.1 million. That means this 2.1 million is the selling price, right? Because they have added a profit inside that value already that has been sold, right? So 2.1 million is nothing but the sales value, correct? So for my perp, firstly, who is the seller? The Argent company or parent is the seller, right? So whatever is the perp, it will affect my working note 5. So my working note 5 will be debited and also my inventory will be reduced, because obviously the subsidiary has purchased it at a higher value. So they have recognized it in their inventory at a higher value. So it will be reduced from their inventory, because when we consolidate, we are going to add the subsidiary's inventory as well, right? So we will have to add higher amount. So we have to reduce perp from there on the face of statement of financial position. Okay. So what is the value of inventory? The value of inventory is nothing 2.1 million, or you can say 2100, right? And here this 2100 that is there, guys, that is nothing but the sales value. And sales includes what? 100% of cost plus 40% of markup. Correct. That means 2100 is nothing but 140%, right? If 2100 is 140%, then what will be the remaining 40%, right? What will be the remaining 40%? So that is what you are supposed to calculate. So we will just simply cross multiply. That will be nothing but 2100 into 40 divided by 140, right? So this is the working for it. I hope it is clear. So our perp here will be nothing but 2100 into 40 divided by 140, right? That is going to give us 600, right? But guys, but there is also goods in transit that must have been sold, correct? You can see here, there is also our goods in transit, correct? As we have done this adjustment here on 20, oops, yeah. On 28th March 2006, this adjustment I'm talking about, they dispatched the goods to lottery company with a selling price of 7 lakh. That means in this also the perp would have been included, because they sold it at the selling price to lottery company, right? So these were not received. These have been sold, but we forgot to do the adjustment of it. So in the perp, our inventory value is not going to be just 2100, guys. Okay, our inventory value is not going to be just 2100, but we will also add the goods in transit here, right? We will also add the goods in transit. That is nothing but 700, right? So the goods in transit were sold at a selling price. So we forgot to add it here. Okay. So here it is nothing but the total inventory will be nothing but because the subsidiary has purchased it, right? We are assuming that it is already included in the subsidiary's inventory. So that will add up to the inventory, right? And that is also sold at a selling price. So our value should not be 2100. Instead, it should be 2800, right? So I'll just make the necessary adjustments here. Yeah. So total inventory is 2800 and thus the per year is going to be nothing but 2800 into 40 divided by 140, right? That is going to give me 800. Now perp will be deducted from where? From the group retained earnings, right? So perp that we have calculated from working note 6, it will be deducted from group retained earnings. That is nothing but 800, correct? So what is the journal entry? For those who do not know the journal entry, it is going to be nothing but, since parent company is the seller, group retained earnings account debit. That means we are deducting from group retained earnings to inventory on the face of statement of financial position account, right? And the value will be nothing but 800, here also 800, right? So we have prepared our working note 6 and we have made the necessary adjustment as well. Okay, or only on the inventory side we'll do it when we prepare the consolidated statement of financial position. Okay, now yeah. So they have given a loan note. So whenever guys they do give a loan note, always keep in mind that also check that what is the non-current liability stated there, right? Because here our loan note is nothing but 8% and technically our non-current liability value, since we have given a loan note, correct? So it is a non-current liability, right? Our 8% loan note value should be 15,000, correct? It should be 15,000, right? But in our non-current liabilities, okay, you can see only 5,000 is there in the non-current liabilities, right guys? In the non-current liabilities, it is only 5,000. And have they provided that if they have recorded it or not? So you can see here further consideration was also issued to the shareholders of Lattery Company in the form of $100 8% loan note for every 100 shares acquired in Lattery Company. None of the purchase consideration nor the outstanding interest on the loan notes at 31st March 2006 has been recorded by Darjan Company, right? So that means this 5,000 is there plus the 15,000 non-current liability that is there, that also should be added because that they have not recorded, and also the extra interest that will be charged on the loan note that they have not stated, that will also be stated. And if there is an extra interest or an extra finance cost, where it will be deducted from? It will be deducted from the group retained earnings, correct? Because the parent company has given this, correct? So I can say maybe unpaid interest. I'll just write unpaid interest. And guys, what will be the value of unpaid interest? 15,000 is not recorded, correct? So 15,000 into 8%. And whatever is the 15,000 which is not recorded directly in the non-current liabilities, that will be stated in the non-current liabilities, okay, in the consolidated statement of financial position. And this will be into 3 by 12, correct? So our value will be nothing but 15,000 into 8% into 3 divided by 12, right? And this will be a negative amount because it is an unpaid interest which is now to be deducted, correct? So that 300 will be deducted, right? Always keep that in mind. Always check the statement, consolidated statement of financial position also that is provided, and also carefully read each and every word because you might miss out on something somewhere, okay? Now heading on to what is next, I think certain adjustments are still pending. We are done with the first one. We are done with the second one. We did the perp adjustment, third one. The fourth one, goods in transit, we've already added and it is to be done on the face of statement of financial position. Records are receivable. This is also on the face, right? The intra-group reconciliation should be achieved. Okay, this is just barely any sort of information that has been given, right? And lastly, the investment in Amri company. The investment in Amri company. Okay, this one is pending, right? So the investment in every company represents 30% of its voting share capital. Okay, so that means Dargent company has an associate also. Dargent company has an associate, and the shareholding in this associate is nothing but 30%, right? 30% is the shareholding in this associate, right? Now, what else have they provided as information? Um, Uses equity accounting to account for this investment Amri company's profit for the year ended 31st March. The profit for the year ended 31st March is stated as 6 million. Okay? So we'll just prepare one working note for this. It will be better. Maybe I can just do it there directly. I don't think there's too much of a mess to be created for it. Where did it go? Yeah. So Dargent company. So guys, now Dargent company's profit for the year is stated as nothing but 6 million, or you can say 6,000, right? 6,000 is the profit for the year 31st March 2006, right? I'll just write it here. For 31st March 2006, the profit is nothing but 6,000, correct? During the year ended 31st March 2006, of which $2 million, Dargent Company has recorded its share of dividend received from Ameri Company in investment income. So obviously the dividend income shall be reduced because we are going to state separately whatever is the share of profit in associate, right? So whatever is the share of profit in associate, that has to be stated separately. So the dividend income which is received from the associate is eliminated, right? So 4,000 is the remaining, right? 4,000 is the remaining, guys, and thus we will just receive 30% of 4,000. That is going to be nothing but 1,200, correct? So I think 1,200 is the amount which is to be stated. Always remember, guys, the dividend which is paid by the associate to the parent company is not going to be considered as an investment income, and only the remaining value, right? Now they have paid a dividend of 2,000. They had retained earnings of 6,000. They have paid out a dividend of 2,000. So that is not stated within my consolidated financial statements, but that is reducing the associate company's retained earnings, right? So now the remaining retained earnings of the associate company is only 4,000, and I will receive only 30% of this 4,000, that is 1,200, right? So where it will be adjusted, it will be stated as share of profit in associate, right? Share of profit in associate, and that will be nothing but the 1,200 that we have calculated. See, 1,200, right? So 1,200 that we have calculated. I think now we have done with all the adjustments. We'll just take the total of the group retained earnings. So the total of our group retained earnings, guys, is going to be nothing but 37,390, right? It is 37,390. We are now done with all the working notes preparation. Okay. Now we are just supposed to do one thing, that is prepare the consolidated statement of financial position. Financial position of Dargent Company for the year ended 31st March 2006. Okay. So this is what we are supposed to state here. Okay. I'll just pinpoint the, I'll just bold the actual answers so that we can take them when we are supposed to take them. Okay. This goodwill, and lastly this also is required. Yeah, that's it. Okay. Let us now prepare the consolidated statement of financial position. Okay. So in our consolidated statement of financial position, the first thing that we see is nothing but the non-current assets, right? In the non-current assets, what do we see? Firstly, we'll write goodwill. that we have already calculated, working note 3, right? The goodwill is going to be nothing but whatever is calculated in working note 3, 11,000, right? Our goodwill is calculated as 11,000. Then we have our property, plant and equipment, correct? So that must be stated. Yeah. So property, plant and equipment is nothing but 75,200 plus 31,500. Correct? So 75,200 plus 31,500. Right? So property, plant and equipment is going to be nothing but, I'll just state this 11,000 here. Why is it not copy pasting? So if in case there are more adjustments, I have sufficient space to state them, right? So what is the value of the goodwill that we have calculated? 11,000, right? 11,000 is the goodwill. Property, plant and equipment is nothing but 75,200 plus 31,500. We also purchase the mine asset, correct? So the mine asset will be stated here 4,000, but the depreciation on it shall be subtracted, that is going to be 200, right? So this is the necessary adjustment to be made, that is 75,200 plus 31,500 plus 4,000, which is the mine asset, because it is recognized as an asset, minus 200, which is going to be nothing but 1,10,500. Okay. Then we have our investment in associate, right? So our investment in associate will be calculated how, guys? Our investment in associate will be calculated as whatever purchase consideration we've made. Is there anything for it? Yes, see here, guys. Investment in Ambry company at 1st April 2005. That is 4,500. So that is going to be capitalized as a non-current asset, correct? So investment in associate is going to be nothing but 4,500 plus the post-acquisition profit share that we got, that was 1,200, correct? That was 1,200, which is stated in working note 5, group retained earnings, this 1,200. Okay. So for the investment in associate, it will be 4,500 plus 1,200, which is going to be 5,700, right? This is the part of my non-current assets. Now we'll deal with current assets. Okay. So for our current assets, guys, we have quite a lot of adjustments to make because there was a lot of intra-group things that we were dealing with, right? So firstly, we will have our inventory, right? So what is the value of our inventory? Yeah, here. Inventory is nothing but 19,400 plus 18,800. First, I'll state that 19,400 plus 18,800, right? From this, the PERP will be deducted, which was in working note 6. Correct, guys? So, what is the PERP in working note 6? That is 800, right? So, minus 800, which is the PERP. I'll put a different bracket here. Yeah, I'll put this. Okay, so 19,400 plus 18,800 minus 800 of POP. Then what else is going to be there, guys? Goods in transit. Goods in transit, we are assuming that it is going to be a part of our inventory, correct? So the goods in transit is going to be added to the inventory, right? That was 700 as far as I remember, right? So the goods in transit is 700. Is there anything else which is pending? I don't think there's anything else which is pending, but let us just look at it once. 700,000 we have already adjusted for this goods in transit. So because of this goods in transit, there was a difference between Dargin company's receivable and payable of Lattery company, that is settled, correct? So that is settled because of this goods in transit. Yes, so I don't think there is anything else which is to be adjusted in the inventory. Only remember this goods in transit of 700, that is also to be reduced from the payables, right? Because its credit entry is nothing but payables, right? I mean, reduced, not added to the payables, correct? Goods in transit, GIT. Okay, right? So what is going to be our value? 19,400 plus 18,800 minus 800 plus 700, right? 38,100 is going to be nothing but our inventory. Then we have our trade receivables. So our trade receivables, guys, is going to be nothing but, how much is the trade receivables? 14,700 plus 12,500. 14,700 plus 12,500, and the intra-group is going to be deducted from the receivables and payables, correct? The intra-group, what was the intra-group? The intra-group reconciliation should be achieved, okay, not this one, yeah, this one. So Dargin company's record showed a receivables due from Lattery company that was $3 million. So this differed to the equivalent payable in Lattery company's records due to the goods in transit, correct? So that 3,000 will be deducted from the receivables and from the payables. So minus 3,000, that is, I'll write current accounts. Yeah. Then our value will thus be 14,700 plus 12,500 minus 3,000, which is going to be 24,200. Correct? We have got our trade receivables. Lastly, I think there was bank as far as I saw. So our bank is going to be how much? 1,200 plus 600. Correct? Our bank is going to be nothing but 1,200 plus 600, which is going to be nothing but 1,800. That is going to be 1,800, right? So with this, we get our total assets, which will be nothing but the sum of all of this, right? That is going to be 1,91,300, right? So our total assets is nothing but 1,91,300. Now let us jump to equities and liability, right? So in our equity, there will be share capital, right? What is the share capital? The share capital only of the parent company will be stated, that is 50,000, plus also we pass this journal entry. We made a share exchange which has increased our share capital by 10,000, correct? So 50,000 plus 10,000, which is nothing but 60,000. So this will be nothing but 50,000 plus 10,000, right? That will be 60,000. Then we had share premium also because of the share exchange. So the share premium is nothing but, directly it is stated because I don't think it is there in the financial statements. That is nothing but 22,000 as calculated, right? See here, to share premium account 22,000, and in the financial statements there is no share premium stated, right? Then we will have group retained earnings, correct guys? So our group retained earnings, which is we have calculated in working note 5. Also the NCI calculated in working note 4. I'm so sorry, I'm having a bit cough today. Yeah. So where is our group retained earnings? 37,390. correct? Then NCI in working note 4, 9430, correct? So I think we have done all the necessary statements that was to be provided to your equity. Now only the non-current liabilities. In the non-current liabilities, we will have 5,000, which was the non-current liability in the financial statements, right? Yeah. 8% loan notes, 5,000 plus the 15,000 which has been given to the existing shareholders of the subsidiary company that has been purchased. So 5,000 plus 15,000, right? So 5,000 plus 15,000, that is going to give us nothing but 20,000. Then in the non-current liabilities, we will also have provision for dismantling or decommissioning, whatever you want to call it. Right? So the provision for decommissioning is nothing but 4,000 plus the 80%, $80 interest which is charged on it, correct? You can see here in working note 2, it is mine provision of 4,000 and plus the interest on provision which increases the provision after 3 months, correct? So, I'm so sorry guys. The total provision is going to be nothing but 4080, right? 4080 is nothing but the total provision, right? Then I guess we also have our accrued loan interest. We have our accrued loan interest that is there, which is not stated yet, okay? Which is nothing but in our working note 5. Right? It is unpaid, so it is going to be adding up to my liability, correct? This one. Where did it go? This one, unpaid interest. Unpaid interest, it is unpaid, correct? So if it is unpaid, it is going to be reduced from my retained earnings and added to my liability, correct? So that will be nothing but 300, right? So my total liability is also done. Now only last thing, that is current liabilities. So current liabilities will be nothing but 24,000 plus 16,400. So which will give me how much? 24,000 plus 16,400. 24,000 plus 16,400. And also guys, don't forget the intra group, whatever is the value remaining, that is to be stated, the current accounts that is there, right? So the current accounts that is to be reduced is nothing but 3,000. I'll write here current accounts, right? I'll just put a different bracket here, okay? So current accounts of 3,000 will be reduced, and also your goods in transit is added to your payables, correct? So your goods in transit is nothing but 700, right? GIT, goods in transit. Okay. So thus our current liabilities will be how much? 24,000 plus 16,400 minus 3,000 plus 700. Correct? So our total will be 38,100. Right? Let us just look at the total of the assets and total of the equities and liability. Total equity and liabilities is going to be nothing but the sum of all of this that we have calculated, which is going to be 191,300. So it has been tallied, right? 191,300 and 191,300. I hope this sum completely is clear to everyone, be it each and every adjustment that we have dealt with, okay? Especially the mining provision adjustment that we have concerned. So always remember, you are classifying decommissioning costs which are to be incurred in the future date as an asset, and you're going to classify it as an asset at its present value, right? Your 4 million is the present value which has already been stated. Otherwise, you would have to calculate the present value by taking 8% cost of capital. Okay. And applying the formula of present value, which is nothing but 1 divided by 1 plus r raised to n, right? Into the future value. Right? So that is going to be asset which is capitalized, and also obviously it is your provision, right? The journal entry is nothing but mining asset account debit to provision for decommissioning, right? So provision is reducing the net assets of the subsidiary and asset is adding up. So I have stated both, right? You cannot just state one of them too, and depreciation of them is stated separately. The depreciation of it will reduce the asset, and here the interest on provision will increase the provision. Always remember this interest is also added in the last part that we have done here in the non-current liabilities, that is 4,000 provision plus 80, because we have to identify the provision at the reporting date, right? So this was at acquisition. After that, we have charged 3 months of interest. So it will become 8. Okay. I hope this sum is completely clear. Now we'll just take a 15 minutes break. After 15 minutes, we are going to continue with a new sum. Okay. Okay, guys, I hope we are back. Shall we continue with the latter part? So let us begin with a new sum. And now we are done with our consolidated sums. So because we cannot cover too many sums of consolidation itself, right? We could also be asked sums on individual entity concepts or something like that, right? So when in case we have a question regarding the individual financial statements to be prepared, at that time we have many things, many components, like they might have covered many chapters, right? So they might have covered many chapters that we are supposed to understand. I'm so sorry, guys. Okay. Now, many chapters like probably they might have included an adjustment of financial instruments. They might have included adjustments for accounting for taxation, right? They might have also included certain adjustments for revenue chapter. So your revenue chapter will be dealt with here maybe. So if in case they do not ask too many questions in section A and section B, they might ask it within the section C in this format. So let us look at let us look at this sum to be able to understand that what this sum components are, right? Before that, I'll just increase the size. Here also I'll make it 60, so it will be visible. Yes? Okay. So let us look at the question. Now this is a Haverford company. Below is the trial balance for Haverford company as at 31st December 2007, which is provided to us. Okay. We have our property, plant and equipment, the ordinary share capital, other components of equity, revaluation surplus, the retained earnings which has been stated, correct? The draft profit. Okay. So we have a draft profit which has been given to us. Probably we might have certain adjustments to be made to this profit. Correct? Then other components of equity, we have share premium. Right? So in other components of equity, it is nothing but the share premium which has been stated. Then 4% convertible loan notes, dividends which are paid out by the company, cash received from the contract customer. Okay, so we have a question on revenue here. Right? Then costs incurred on contract to date. Yes, so we have a question on revenue here. We have an adjustment of revenue. Inventories, we also have an adjustment for inventories. Trade receivables, cash, and current liabilities. So let us now look at the adjustments. Okay, and firstly, what is the required? What is the required part? It is nothing but calculate the adjusted profit for Haverford company for the year ended 31st December 2007. Right? So probably this might be for maybe 6 marks or something. 6 marks, or maybe not 6 marks, probably 4 marks. Right? Prepare the prepare the statement of changes in equity. This would probably be for 6 marks, statement of changes in equity, and prepare the statement of financial position. So this would be for the remaining 10 marks. Okay, I think this is probably the marking scheme which is provided here. Okay, so guys, now we have to firstly start with each and every adjustment. So let us look at the first adjustment. On 1st January 2007, Haverford Company issued $80,100 4% convertible loan notes. Okay, so this is a question on financial instruments. Okay, now the loan notes can be converted into equity shares on 31st December 2009, that is after 3 years, correct? Or they can be redeemed at par on the same date. Okay, an equivalent loan without the conversion rights would have the required interest of 6%, and the interest is payable annually in arrears on 31st December each year. right? That means the interest is payable annually in arrears. Okay. The annual payment has been included in the finance cost for the year. Okay. So whatever is the annual payment made, that is included in the finance cost. So when we see, is there a finance cost provided to us here? Okay, there isn't. But anyway, they are just stating that it is included within the finance cost. And obviously, they have also stated that an equivalent loan would have a 6% interest rate. That means 6% is our effective interest rate and 4% is the interest rate on the bond, okay, on the convertible bond. So they have given us the present values for each one of them. We are just supposed to calculate the convertible loan note. So how we are supposed to deal with the convertible loan note? Do you all remember? So in your financial instruments, when you are issuing a convertible loan note, whatever is the total proceeds, or you can say the total issue proceeds, right, that you receive on issuing the convertible shares, the convertible loan notes, you receive money from the holders, right? You receive money who purchases your loan notes. So whatever is the proceeds. Now, obviously, this is your convertible loan note, so it has a liability component and also an equity component that we are supposed to deal with, correct? Because here the holder has a right to actually receive the interest payments and also receive the capital repayment, and with that they also have the right to actually convert them into equity shares of the company, right? So we have to calculate the liability component, assuming that the total contract is nothing but a complete liability, right? So we have to calculate the liability component, and thus from the total proceeds, when the liability component is deducted, we will also eventually get equity component as nothing but a residual interest which is remaining. Okay. So let us discuss this sum in detail. Okay. So first we will prepare a working note 1 for this, that is convertible loan note. Okay guys, so we have our convertible loan note here. Okay, and for this convertible loan note, we will first see, we will calculate the present value of the cash flows so that we can identify the liability component using the effective interest rate, right? So payment or cash flows, whatever you want to call it. Then payment, we have our discount factor, right? So discount factor that we are going to use for discounting the cash flows is nothing but 6%, because that is the effective interest rate, correct? So that will be 6%, and thus we will get our present value. And also I'll mention the date here. Okay. So date will be nothing but first one, I guess it is evenly, I mean it is accrued at the year end, right? So 31st December of each year, right? 31st December 2007, then 31st December 2008, and then 31st December 2009, right? Because it is going to be redeemed in the year 2009, correct? You can see here, the loan notes can be converted into equity shares on 31st December 2009, or also redeemed at par on the same date, right? So if it is redeemed at par, firstly, what is the cash flows? The cash flows are nothing but what value of loan note is issued? It is 80,000, correct? You can see the first line, 80,000 value of loan note is issued. So 80,000, and on that, how much interest rate are you paying? Interest rate that you're paying is 4%, correct? So 4 divided by 100. So your cash flow is nothing but 3,200, or I'll just state it as 320 here. Is it 80,000 or 8,000? 80,000, but it is $100, right? Yes, I forgot that. It is 80,000, but it is $100 4% convertible loan notes, right? So then technically it is going to be nothing but 8,000. So I'll just take 320, and in the last year it will be 320 plus the repayment of 8,000, correct? So 8,000 plus 320, which is the repayment. In the last year, you're going to make the capital repayment of 8,000 and also the 320 cash flow payment, correct? So what is the discount factor? 6%. What is the value stated? 0.943, 0.890 and 0.840, correct? So I'll just put equal to sign and copy paste. 0.943, 0.890 and 0.840, right? So let us calculate the present value. It will be nothing but 320 into this cell, which will give me 301.76. And as I press this, I'll just drag this down. So it will get me the same values. This is this into this, and this one is this into this, right? So the total liability component. Why are we calculating it at 6%? That is because for a similar loan note without the conversion option, the interest rate is 6%. That means if there was a loan note without the conversion option, the interest rate on it would be 6%, but only because this is a convertible loan note, the interest rate given on it is less, right? Because the holders also have an option to convert it into equity shares of the company and enjoy the benefit forever, right? Through holding it, correct? So here they were given 6%, right? So we have to assume that this instrument is not a convertible instrument and a liability, complete liability instrument. That means a normal loan note without the conversion option. And if it is a normal loan note without the conversion option, obviously the discount factor that we will apply is 6%, correct? So our liability component will thus be nothing but the total of all this cash flows, which is present valued, that is going to be 7575.3, right? 7575.3. Now let us calculate the equity component from here. So our total proceeds guys is nothing but 8,000, right? And from that the liability component is deducted. So the liability component we have calculated 7575.3, right? It is actually 757, I'll take it as 6 million. 7576. So the equity component will be nothing but the difference between the two, that is nothing but 8,000 minus 7576, which is 4,24,000, correct? So let us look at one thing now. What is the liability stated at here in the trial balance? Yes, 4% convertible loan note. It is stated at 8,000. That means they did not understand, or they have not stated it correctly, that if it is a convertible loan note, the complete 800,000 does not go to your liability section. It goes to your equity section also. Correct? So we have to reduce the liability because they have stated liability higher, that is 800,000. Correct? And liability is only 7576. So liability account debit, liability amount will be reduced. Account debit, and it will go to your equity reserve, right? Equity account, right? That will be nothing but 4,24,000, which we have calculated. Right? So this is our first adjustment which was required to be made. Always remember, when in the financial statements you state liability will be 7576 and equity will be 424. Okay, just keep that in mind. Now let us look at the next working note. The next adjustment. So we are done with the first adjustment. Okay, this was the first adjustment that we are done with. Let us look at the second adjustment. During the year, Haverford Company entered into a contract to construct an asset for a customer, satisfying the performance obligation over time. Okay, so this is the question on revenue. Correct? Satisfying the performance obligation over time. The contract had a total price of $14 million. The cost to date is 1.9 million, which are included in the above trial balance. So you can see here, the cost to date are stated as 1.9 million, that is 1900, right? Then cost to complete is $7.1 million. At 31st December 2007, the contract is estimated to be 40% complete, and to date, Haverford Company has received 1.4 million from the customer, and this is shown in the above trial balance, right? So it must have been shown in the above trial balance. Cost incurred to date, cash received from the contract customer note, that is 1400, right? 1.4 million. So let us look at the working note 2, that is for revenue. So if you know the small chapters, you can deal with this sum quite easily because you know them in depth. Okay, one by one. Now, so if you remember, we calculated step by step. We'll take step 1, step 2, step 3 and step 4 for calculation of what is going to be stated where and by what amount, right? Because here we have to prepare three things: the statement of changes in equity, the adjusted profit, and also our statement of financial position, correct? So the step 1 is nothing but the expected outcome is to be calculated, if you remember. So expected outcome is nothing but the total contract price. From this, cost to date will be subtracted and also the estimated cost to complete. Right? So what is the total contract price? The total contract price, guys, is nothing but, where is that adjustment? Yeah. So the total contract price is 14 million, right? The third line, the contract price has a total price of 14 million. So I'll write here 14,000. Okay. The total contract price is 14,000. The cost incurred to date are nothing but the cost to date is 1.9 million and the cost to complete is 7.1 million, right? So 1.9 million, that is 1900, and the estimated cost to complete is 7,100, correct? That is 7.1 million. These two are going to be negative amounts in order to identify whether the expected outcome is profitable or not. And let us see. So I guess obviously it is profitable. Yes. So we have a profit, an expected profit of 5,000. So if we assume that we have an expected profit of 5,000, whatever is the calculation of revenue and everything will be done on the progress percentage basis, correct? So step 2 is nothing but progress percentage calculation, which has two methods, input and output method. But we do not need to calculate here because that is already mentioned in the question as 40%, right? Step 3 will be nothing but in your statement of profit or loss, what do you recognize, right? So your statement of profit or loss, right? I'm just showing the base here. That is going to be revenue. That is nothing but 14,000 is the contract price into 40%. And also the cost of sales is nothing but 7.1 million plus 1900, I mean 1.9 million, which is nothing but 9,000 into 40%, correct? So our revenue will be 14,000 into 40% and cost of sales will be nothing but 9,000 into 40%, correct? So cost of sales is 3,600 and revenue 5,600. Our profit for the year is going to be nothing but 2,000, correct? 2,000 is our profit for the year. Always remember this revenue and cost of sales will be adjusted in the profit, adjusted profit calculation that we are supposed to do, because in the question they've asked us to prepare calculate the adjusted profit, right? So this will be adjusted in that profit. Don't forget that. Okay, so we have calculated our profit also. Now the last, that is step 4, that is calculation of the statement of financial position, whether it is a contract asset or a liability, right? So for our statement of financial position, whatever is the revenue recognized is nothing but the cost incurred to date, right? Why do we consider it as revenue recognized? That is because we assume that the project is going to be profitable. We are expecting the project to be profitable. So whatever costs we have incurred to date on this project, those are going to be recoverable. Correct, guys? The cost incurred to date on this project is going to be recoverable in the future date because project is actually eventually is going to bring me a profit. Correct? So the cost incurred to date is nothing but recognized as revenue right now, so that in the future date when the customer pays me, at that time I will receive it, right? Because it is recoverable, I am stating it as a revenue. If the expected outcome was a loss, then in such a case I cannot do so. Okay, I have to recognize immediately a loss and treat it as a onerous contract. Okay, so the cost incurred to date are nothing but 1900, as we know. right? Then the uh, profit for the year, that is also going to be a revenue recognized by me, right? From the contract only, right? So this profit 2000. And from this, guys, from this, is the font size changed? Okay. Yes. So it is not changing. I don't know why. Anyway, so the profit for the year is stated as 2000, and from this we will deduct the amount billed to date, right? Amount paid or amount billed to date. Contract asset is nothing but and the amount of money that we have spent and the amount of progress that we have done that we have not asked for the customer to pay for. Okay. So if we ask for the customer to pay for that amount of money which we have spent and the progress that we have made, then it will be treated as a receivable for us, right? Because then the customer, if we have actually invoiced it to him, then he will be liable to pay, right? So then it will be a receivable. And if he pays for it, then it is no more a contract asset or a receivable for us, right? So a contract asset is something which for which we have worked and we are done with the progress, but we have not even asked the customer to pay for it. Okay. So lastly, the amount which is billed to date, which it will be subtracted, which was I think nothing but 1400, right? As far as I remember, it is 1400. You can see here it is received as $1.4 million. So it is going to be 1400, correct? So our contract asset is nothing but 2500, right? So we are also done with the working note to revenue calculation. Now heading on to the next working note probably, right? These might have quite a big working notes and a lot of adjustments as well, but please don't worry. The more you focus on certain unnecessary things, like I've stated here step 3 separately and all that. Sorry, step 2 and separately, that is already mentioned. So you do not waste your time in presenting all that. Just directly calculate quickly as possible, and then you can present the working notes separately. Mainly your concern should be preparation of the financial statements, not the preparation of the working notes. Okay. Then, what are the other adjustments? We are done with 2 adjustments. Let us look at the third one. Okay. So, the third adjustment says Haverford Company has made a 1 for 5 bonus issue. Okay. So, here we have our earnings per share chapter. I'm so sorry, guys. Yeah. So, we have a 1 for 5 bonus issue on 31st December 2007, which has not yet been recorded in the above trial balance. Haverford Company intends to utilize the share premium as far as possible in recording the bonus issue. So when we are providing the bonus issue, it is nothing but a shares which are issued to the existing shareholders of the company, which is actually issued for free, right? So in case where the company does not have any sort of dividends to pay out to its existing shareholders, or if they do have cash to pay out the dividends, but they want to preserve it for some other expenses or investment in a project, then in such a case they make a bonus issue. That means free share issue, which is nothing but a substitute to the cash dividend which the companies usually pay to the existing shareholders of the company, right? So it is given as one share issue for every 5 share which is held by the shareholders, right? So if the shareholders are holding 10 shares, they will get 2 shares as bonus issue on it. Okay. Now for this bonus issue, guys, they are going to pay from where? They're going to pay from the share premium as far as possible, right? So firstly, let us look at the bonus issue, right? So our bonus issue, guys, is nothing but the share capital of the company. First, we have to look at, because it is a 1 for 5 bonus issue. So ordinary shares of the company is 20,000, right? Ordinary shares is 20,000. On this, there is a bonus issue of 1 for 5 shares, correct? So 1 divided by 5. So that means for 20,000 shares which are in issue, I will give 1 share for every 5 shares, right? So 4,000 shares I will have to issue, right? So it will be 2 share capital, right? 2 share capital account because I'm issuing shares of 4,000, right? And where will I adjust this from? They said you have to adjust it from share premium as far as possible, right? Share premium account will be debited. That means since it is a part of equity, if I debit it, I am removing it. Okay. So you can see, let us look at the share premium, how much it is stated. Yes. Other components of equity has share premium and that is 3,000. Oh, we have only 3,000 here guys, right? And the shares that we have issued is 4,000, correct? So the remaining will be adjusted from the retained earnings. Okay. So our share premium will be debited by 3,000 and the retained earnings will be reduced by 1,000, right? This is debit and this is also debit, right? So this is the journal entry that we will pass and we will also make the necessary adjustments in the statement of changes in equity. Okay. Now moving on further with any other adjustments which are pending. So working note 4, I'll just prepare. Okay. Now we are done with adjustment number 3. Let us look at adjustment number 4. Haverford's company property had previously been revalued upwards, leading to a balance on revaluation surplus on 1st January 2007. The property had a remaining useful life of 25 years on 1st January 2007. So firstly, they have a revaluation surplus balance, right? At the start of the year. So it must have been stated here somewhere. Yes, revaluation surplus at 1st January 2007, it is 800, right? So the balance of revaluation surplus is there, that is stored 800 for the same asset, right? For property. Now the property had been revalued upwards and for that the balance is stated. The property at that time had a remaining useful life of 25 years. That means at the start of the year, its remaining useful life is 25 years. At 31st December 2007, the property was valued to 16 million. That means at the year end, it got revalued to 16 million. No entries have yet been made to account for the current year's depreciation charge or the property valuation at 31st December 2007. Haverford does not make an annual transfer from the revaluation surplus in respect of excess depreciation. So we are not supposed to deal for excess depreciation, right? So let us look at the calculations of property, right? So for our property guys, the balance or you can say the cost at 1st Jan 2007 is nothing but what is the balance? At 1st Jan the balance is we have not seen that, correct? Yeah. It was just stating that it was revalued. So what is the balance at 1st Jan? Yes. So property is carrying amount at 1st Jan, the first one, 18,000, right? So the balance of the property, plant and equipment or the cost of property, plant and equipment at 1st Jan is nothing but 18,000, correct? Then we will charge depreciation for the full year on this, right? Because it got revalued at the year end, right? So depreciation will be included here and that we have 25 years remaining useful life, right? So the depreciation here will be 18,000 into 25 years, sorry, divide by 25 years. And thus the depreciation value will be nothing but 720. The carrying value at the year end, that is nothing but 31st December 2007 is going to be nothing but 18,000 minus 720, which is going to be 17,280, correct? It got revalued. It got revalued to what amount? Revalued amount is nothing but 16,000, correct? It has been stated clearly that the revalued amount is 16 million. You can see here, I guess, yeah, this one. At 31st December, the property was revalued to 16 million, right? So that means there is a revaluation loss here. because my carrying value is greater than the revalued amount. 70, the revaluation loss is nothing but 16,000 is its new value minus its carrying value of 17,280, right? That is going to be 1280, right? Now, normally, where does the revaluation loss go? The revaluation loss goes to your P&L as an impairment charge, probably on an asset, right? So, okay. So, firstly, is this a revaluation loss or an impairment? We have to also look at that. Yes. At 31st December 2007, the property is just valued to 16,000. Okay, probably it can also be its recoverable amount. We are just assuming that maybe it's not the revaluation because it is not mentioned that its fair value is that. So we will probably treat it as an impairment. Okay, because maybe its recoverable amount has reduced. Yeah, so its impairment is 1280. Now, where does usually the impairment expense goes? It goes to P&L. But if there is a previously accumulated revaluation surplus, then you cannot have a revaluation surplus of 800 and simultaneously have a P&L loss of impairment of 1280, right? So first you have to eliminate that revaluation surplus of that property, right? So I will just debit the revaluation surplus account debit, that is going to be 800. So revaluation loss is revaluation surplus in OCI is completely eliminated, right? Then we have the remaining as an impairment expense, account debit, and to asset going down by that value, I'll just write property. To property account, that is nothing but 1280 that we have calculated. So it will be 1280. And thus the impairment expense that is to be charged to P&L is nothing but 1280 minus 800. That is going to give me 480, right? This will go to your P&L. And always remember, this will reduce your profit, obviously, because it is going to your P&L. So when we are adjusting the draft profit, we will reduce this from it. Okay? Please keep that in mind. So we are done with I think working note for property, plant and equipment, right? Then I think there's just one more last working note which is pending. Yeah, this is this one. It has been discovered that inventory totaling $0.39 million had been omitted from the final inventory count in the above trial balance. So that means it will be added back to the inventory if it has been eliminated from the inventory count, correct? So the last working note, that is probably working note 5, inventory. What is the inventory as per trial balance? And the closing inventory will be added to it. So inventory as per trial balance yes, inventories as per trial balance is 4310, correct? So inventory is as per trial balance is stated as 4310. And what is the closing inventory value? The closing inventory value is 0.39, correct? So that means technically 390, right? So closing inventory of 390 will be added, and thus the total inventory will be nothing but 4,700, right? And since my closing inventory is added here, it will also be adjusted in the profit, okay? As it is increasing my closing inventory, correct? So it will be added to the profit. Then I think this is it for the inventories and for all the working notes that is to be prepared. Now let us look at what is required and accordingly present, right? So firstly, you have to calculate the adjusted profit for Haverford Company for the year ended 31st December 2007, right? Adjusted profit for Haverford Company for the year ended 31st December 2007, right? So let us calculate the adjusted profit. Firstly, we'll take the draft profit as per trial balance and then we will make the adjustments to it. Okay. So what is the draft profit stated in the trial balance? Yeah, that is 2250. Correct? 2250 is the draft profit stated in the trial balance. We have to make whatever are the adjustments to it, right? There was a finance cost on it on the convertible loan note, so finance cost will reduce my profit, and also the payment made will be added back. Correct? Oops. Yeah. So here, okay, we have forgotten one thing here, guys. That is the subsequent measurement of our liability, right? We have forgotten the subsequent measurement of our liability to be made. So I'll just make that also. Yes. So let us make the subsequent measurement of liability. Correct? Because obviously the finance cost, whatever will be the year-end non-current liability, all that is to be stated. Correct? So firstly, we have our balance brought forward for the subsequent measurement. Then we will have our effective interest rate, that is nothing but 6%. Then we will have our payment made, that is nothing but 4%, right? And lastly, we will have the balance carried forward. Correct? So the balance brought forward is nothing but the calculation that we've done, which is 7576, right? So I'll just write here 7576, right? This is the balance brought forward. Effective interest rate of 6% will be 7576 into 6 divided by 100, right? And obviously effective interest rate will add up to my liability, correct? Yes. I think in this much space it will be done. So now my payment made is how much? It is nothing but it will always be taken not on the present value but the face value. That is nothing but 8,000. So 8,000 into 4%, that is going to be 320. And yes, obviously payments are going to reduce my liability, and thus the liability at the year end that I identify is nothing but 7710. Correct? It's going to be 7710. The journal entries that we are going to pass for the effective interest rate is nothing but our finance cost, account debit to liability being increased by it, right? That is 454.56. We'll just take it as 455. Okay. And the payment made will be nothing but liability being reduced by that amount, account debit to cash going out of the business, right? That will be nothing but 320 and 320. Correct? So what is the net effect? It is nothing but 455 minus 320, and thus the net effect to my profit will be 135. So obviously finance cost is higher, so 135 will be reduced from the profit. Okay. So minus 135. Right? This was for the convertible loan note. Then I think we have our contract asset and contract liability, correct? Sorry, not the contract asset, the contract revenue and contract cost of sales, right? So revenue will increase my profit, cost of sales will reduce my profit. I'll state both of them. Contract revenue and contract cost of sales, right? 5,600 will be added, 3,600 will be subtracted. Then in the working note 4, if you remember, there was depreciation on the property, right? So that depreciation will reduce my profit, correct? So what is the depreciation in working note 4? You can see here 720, correct? So 720 is the depreciation charged here. Then obviously the impairment will also affect. So the impairment of property, right? My property is impaired, so it will go to my P&L, correct? And that will be 480, right? It is going to reduce my profit, right? And the closing inventory has increased, so that will increase my value here of profit. That is going to be nothing but 390, right? And thus, I think there is nothing else pending. So the adjusted profit will be the total of all this. That is going to be 3305. Okay. This is the adjusted profit. Now, let us make the statement of changes in equity. Right? Or what is the name of the uh, company? Haverford Company for the year ended 31st December 2007. Haverford Company for the year ended 31st December 2007. Yeah. So let us get started with this. Whatever is there, whatever are the components here, I'll just state that. Firstly, we have the share capital in the statement of changes in equity. Then what else do we have, guys? Share premium is there, right? In the other components of equity, right? Other components of equity, OCE, I'll state it as. Then there is retained earnings. There is revaluation surplus. Yes. Then what else is there, guys? Revaluation surplus. Anything else pending? Yes, option. Right. So I've treated my convertible loan note, right? In my convertible loan note, my equity is stated as an option as of now. When in case they convert it, then I'll issue their share capital, correct? So equity is stored as a reserve now. So I'm stating the value. I am stating the column option for that. Okay. So firstly, we'll state the balance at the start of the year, whatever is the balance brought forward. That is nothing but for the share capital. It was how much? I guess 28,000 or something. 20 or 30,000. What was it? Yeah, 20,000. So ordinary share capital is 20,000. Then other components of equity, your share premium was 3,000, right? Then the retained earnings. What is the retained earnings? Yes. See your other components of equity, 3,000. Retained earnings at the start of the year, 6270, right? So at the start of the year, the retained earnings is 6270. Yes, we have our retained earnings. Also, the revaluation surplus was there, 800, right? And lastly, option, it was actually made mid-year, right? When was this convertible loan notes issued? On 1st Jan. Okay, the convertible loan notes were issued on 1st January, but I want to state it separately, so I'll do that. Okay, I'll just state it convertible loan notes. Okay, and there I'll state 424, which is the equity value. Okay, then what do we have? We have firstly the revaluation. Okay, the revaluation loss or something, right? Or you can also call it as an impairment, but here it is deducted in the form of revaluation loss, right? So the revaluation loss had eaten up my revaluation surplus. So this is minus 800, right? So this became nil, right? Then what else is there in my retained earnings? Maybe I will adjust, correct? Firstly, there is a bonus issue, correct? So the bonus issue will be adjusted. Now the bonus issue is nothing but my share capital was increased by 4,000, right? The journal entry that we passed to share capital. This will be share premium and this will be retained earnings, right? So bonus issue of 4,000. Other components of equity has been reduced. That is your share premium. And from retained earnings, 1,000 is reduced because of the bonus issue. Correct? Now the bonus issue is made. Dividend, if in case any is paid, dividend, right? I saw one thing, dividend paid. So that will reduce my retained earnings. I saw it in one of the adjustments. No, maybe in the trial balance I saw. Yeah, see here. Dividend paid. So dividend paid is 3620. So that will reduce my retained earnings, right? So minus 3620. That is the dividend paid. Okay. I don't think there is any other adjustment which is pending here, right? Okay. So the profit for the year I have not stated, right? Whatever is the profit for the year, that is also added to the retained earnings, correct? The adjusted profit that we calculated, I forgot that part, right? That is 3305, right? So the adjusted profit will be added to the retained earnings, and thus the balance at the year end, balance carried forward, or balance at 31st December, will be nothing but the sum of all this, that is going to be 24,000, and I'll just drag it here. So I'll get the totals of all of them, right? So this is 0, and I've got the totals of each and every one of them at the year end. Okay. Now, we'll just prepare the last thing, that is statement. Wait, yeah. Statement of financial position of Haverford Company for the year ended 31st December 2007, right? Sorry. Okay. In this, the first heading is going to be nothing but non-current asset, where I will have my property, right? That is already calculated in working note 4, right? So in my working note 4, my property is already calculated. Yeah, see here. So the property new value is 16,000, correct? Because it is calculated at the year end. So it is nothing but 16,000. Yes. So that is my property valuation. Then in my current assets, I will have inventory that is already adjusted in working note 5, right? So my inventory is already adjusted in working note 5. That is total inventory 4,700, right? Anything else that is there in the current assets? Yes, my trade receivables. Trade receivables, guys, is nothing but 5510, right? Then also my contract asset will be stated in the current asset because of the revenue thing, right? So my contract asset is 2,500, right? So trade receivables is nothing but 5,500. Sorry, is it 5,500 or 5,100? Okay, 5510. Oh, 5,510. Yeah, and my contract asset is going to be stated here because of the working note 2, correct? And that is nothing but 2,500 that we have calculated. Where is it? Where is it? Yeah, this one. Okay, 2,500, right? So that is going to be my contract asset. I think now I've covered almost everything. I think cash, I saw something which is pending. So cash is how much? Yes, cash 10,320, right? So I'll state that 10,320 cash. This is the total of my assets. So my total assets will be nothing but the sum of all this. That is going to be 39,030, right? These are my total assets. I hope it tallies now. Equity and liability, right? So in the equity and liability, guys, firstly, in the statement of changes in equity, I've already calculated everything, be it for the share capital or the share premium, right? So I'll just take the balances, right? So 24,000 is my share capital. Then other components of equity, it is 0, right? Then I think there is retained earnings. So what are the retained earnings? 4955. Yes. Then the revaluation surplus, that is also 0 because it got impaired later on my asset, correct? And lastly, the option part of the share capital of convertible loan note, that is going to be 420, right? So these are all the components that has been included here. Okay. Then lastly, our liabilities, our non-current liability, right? So in the non-current liability, we will have convertible loan note, right? The non-current liability which we've calculated in working note 1, right? So that will be nothing but after the subsequent measurement, that is, guys. So that is going to be C, the subsequent measurement of liability 7710.56, right? I'll just write it as 7710, okay? Because then it won't tally with a perfect value, okay? Then, or 0.56 it is, right? I'll take 771. Okay. Lastly, our current liabilities are nothing but 1940, right? So our current liability is 1940. Thus, the total of my liabilities is going to be nothing but equities and liabilities. It's going to be nothing but the sum of all this, that is going to be 3930, right? 39030, 39,030, right? Total equity and liability. Yeah, it got tallied. This is also 39030, and here also we got the same value, right? So this is the whole financial statements that we have prepared, be it for the statement of changes in equity, the working notes for your financial instrument, for your revenue, for your bonus issue, for your property, plant and equipment. So these kind of questions, individual financial statements preparation can also be asked. So please solve certain sums from this part also, right? This just judges your basic knowledge of different chapters that you have dealt with, right? So is the reason why I usually say don't skip any chapter, right? If you skip any chapter, and if for example you skipped financial instruments, which is not to be skipped obviously, for example you skipped earnings per share, your bonus issue won't be calculated, your statement of changes in equity will not be prepared, your statement of financial position will not be tallied. So is the reason why the chapters here are quite important. I do not want any of my students to skip any of the chapters for your financial reporting. Okay. So with this, guys, we are done with this sum also, which is an individual financial statements. So I've explained you that what kind of sums can be asked. Firstly, we have solved consolidation, in which case we have dealt with two things. One is the consolidated statement of financial position preparation. Second one, the consolidated statement of profit or loss with goodwill calculation. These are the most frequent two, ways that they ask for consolidation, right? Then we have also solved our individual financial statements, this sum, right? And ratios. I cannot start ratios right now, otherwise the timing will be exceeded too much, right? So tomorrow we will be continuing with our ratios one sum and also the mock test. Okay, guys. Tomorrow and day after tomorrow are going to be our last two classes, wherein we solve two mock papers and one sample question which is pending, which is our ratio sum. Probably tomorrow and day after tomorrow, the lecture will be extended a little bit. So until then, have a good night, and we will meet in the next class, that is tomorrow. So thank you guys. Thank you so much.